Well, you've heard the movie 40-Year-Old Virgin with Steve Carell. This is not quite as fun. In Canada, as of 2025, the average age of the first-time homebuyer in Ontario is actively 40 years old. And while I think some landlords are probably putting up a toast to tenants for longer, this is actually not a good thing for the economy as a whole. Now, before I go too far, I should preface by saying the average age of first-time buyers is different in different provinces. But when you look at BC, specifically the Vancouver area, and then Ontario, specifically the Toronto area, the age just keeps going up. And here's a crazy stat. Back in 1981, when rates were as high as 22%, the average first-time buyer's age even then was 31 years old. So this is not a good sign. So I'm going to talk about all the different ways that you as a first-time buyer can get your butt in the market and make sure that makes sense. But before I do that, let's talk a little bit about some of the reasons why this is actually a bad thing overall for first-time buyers and the economy. All right, by the end of this video, you're going to figure out exactly why you should get in the market earlier and how to do it. I'm going to give you 30 reasons rapid fire that you can start thinking about to be able to make your move into the real estate market right now. First up, FHSA contribution. This is a tax savings account that you've had access to now for a few years in Canada, and it's an absolute no-brainer. You have access to $8,000 per year of contribution, but here's a tip. Make sure you put at least $1 in it each year, even if you can't put $8,000, because if you do that, you actually extend the contribution room. This is tax-free money, it reduces your income, and of course, it gives you an opportunity to pay less taxes to the government. Only good things. Second up, the actual RSP contribution room. This has been around forever. Your company gives you an RSP, you can match your RSP, you're going to contribute, reduce your taxable income as well. Well, a few years ago, the government allowed it so that you can borrow up to $60,000 from your RSP tax-free as long as you pay it back within 15 years. An absolute no-brainer to use this one as well. Here's the catch. You only need to have your money in your RSP for 90 days before you withdraw it. So you can put in there for 90 days, get the tax refund, and then use that for your down payment. Using a 30-year amortization. For some crazy reason, the 30-year amortization is vilified. As of December of 2024, as a first-time buyer, you can use a 30-year amortization to squeeze yourself into the marketplace or reduce your monthly payments. Maybe put that money into the down payment and pay off some other debts. Truth is, the 30-year amortization is not a bad thing. It's a tool that gets you into the market. If you pick a mortgage product that's flexible, then you could just pay it off faster if you want to. All right, this one's probably not my favorite, but there is an option. There is an applied shared equity program in Canada, and there are different lenders who use this types of programs, and essentially they will invest in a piece of real estate with you to qualify to purchase a home. Now, again, you got to be careful, pay attention to who you're investing with and what the program is, but there are plenty of different programs out there to get you into the real estate and start building equity. Another factor you need to consider as a first-time buyer is your credit score. If you get a credit score of 680 or higher, you can get into the real estate market, and it doesn't take long if you've had bruised credit to go from 650 to 680. In fact, you can do that in as little as 3 months. A big gap for most first-time buyers is they don't get two credit lines, like a credit card and a line of credit, or 2 credit cards that you use every single month. And so a lot of times I see first-time home buyers who are trying to get in the market and they haven't spent a few minutes to set themselves up when it relates to your credit. And some of those apps that are out there, I won't name any of them, are okay to track where you're at from a credit perspective, better than nothing, but they're not always 100% accurate. So make sure you're directly connecting with Equifax if you want to know exactly where you stand. This is a big one for me, using alternative lenders. There's so many people that avoid the marketplace because a bank or a credit union, a mortgage finance company like a monoline won't give them financing. In fact, over 35% of our business is with business owners who can't qualify with conventional financing. Yet we can take them to alternative lenders who use their bank statements or help them out if they have credit issues, or use the revenue from their company to help them qualify for loans. And the crazy thing is they're still saving money when it comes to their taxes, or they're able to get in the market and build equity. A lot of people vilify these programs because they don't understand them and they think the rates are substantially higher than they actually are. This is a huge way to get in. All right, another fantastic option. Listen, people are afraid to do this, but you can co-sign. Family member, friend, someone that you know, you can co-sign on a property. The key to this is to make sure that that person knows that obviously if you don't make your payments, then they're responsible. And the second key is to make sure that you always have a joint venture agreement. This is massive to protect yourself in case that other person does something or tries to run off with your property or your equity in your home. All right, believe it or not, we're already at number 8, and this one has been kind of controversial, but a lot of first-time buyers have been doing this in the last couple of years, which is to target more affordable cities. You are not a tree. You can move. And there's a lot of people who are moving all over the country to different cities that have more affordability. And that is one of the biggest reasons we've seen places like the Maritimes and or Alberta boom in the last couple of years, because you could buy a detached house in Edmonton for $600,000, which is barely a condo in Toronto. Not everybody's going to want to hear this, but if you work 9 to 5, what are you doing with your 5 to 9 before and your 5 to 9 afterwards? What about starting a side hustle? Do you have the opportunity opportunity to work on the weekends, add another skill. With the increase in technology with AI, you have the ability to consolidate your work down potentially to do an extra 1 or 2 hours a day on something else, or start a business that's going to generate the extra money and set that money aside into an investment, or use that money towards the potential down payment of your future property. Believe it or not, there are provincial and municipal grant programs that are available for certain people. I'm not going to walk through all the different types of grants and loan programs. Perhaps I'll do a separate video about some of the big grants that are out there, but some of these grants can actually give you access to money or funding or a down payment, and they are available countrywide, different places, different cities. In any case, check with your local municipality or your provincial government. Depending on your situation, you may qualify for a grant. So check it out. That might help you get into the marketplace a little bit sooner. You're going to love hearing this. There's this thing called a property ladder. Buy a freaking condo first. I know people in Ontario aren't going to love hearing that, but if you hold on to it for long enough, generally speaking, it's not the worst investment and you can build equity. The key obviously is to make a smart purchasing decision. And I think that's where a lot of people maybe lost money and or are losing money who made condos look bad. My first property was a condo. I still own it today. I make money on it from a cash flow perspective. I've used the equity to purchase multiple properties from that condo. So if you purchase that condo and you make a smart decision today and you have a long-term hold, it could be the right move for you to stop renting. What about looking at the square footage? Do you really need a 2,500 square foot place? Could you look at something at 1,500 square feet to help you get your foot in the door? Again, often it comes down to someone's big dreams and they're not willing to take the steps up the ladder to get there. Another idea, what about a vendor take-back mortgage? There are still mortgages out there at 2% where you could assume those loans, or the seller can't get rid of their property. What about convincing, and I've actually seen this happen, them to do a vendor take-back where they don't have a mortgage on the property and they're willing to put a loan on the property at market or lower rates to get you into a property. There's ways that you can do that without even having a down payment. Again, I've actually seen people do this. We don't arrange them for clients, but I've heard about them and actually seen them happening. And this is a way that smart people are taking advantage of a quote unquote down market. This one was really popular a few years ago, and we haven't seen it happening for probably 3 to 5 years very commonly in most markets, but it's a rent to own agreement. Basically what this is an agreement in place with the seller that over a period of time, say 3 years, you're going to rent a property at a certain value, and a portion of that is going to go towards the down payment of the future property. You also have to save up some additional money on the side, but it does go against the down payment, and it allows you to actually agree to a purchase price of the property at that time so that you can purchase it and know that at the end of the 3 years, some of your money is actually going towards the equity in the home and you can complete your purchase at that time. What about buying a fixer-upper? What happened to the days where people actually purchased a piece of real estate that wasn't in the greatest condition today, that needed a little bit of work? Are you willing to do that sort of thing? If you have skills, whether you be in the trades or maybe you're just someone who is handy, if you're willing to put in the time and the energy, you can buy something below market value, assuming the bones of the property are good and benefit really, really well. Now, I kind of touched on this before about a co-signer, but what about a cohabitation agreement? If you have a roommate right now and you really like your roommate and you've lived together for a long time, why don't the two of you guys get together, come up with an agreement, and both purchase a piece of real estate together? This could get you into the marketplace, but also be a situation where you can actually own the home with them. Maybe you have a 5-year plan, a 3-year plan, or a 10-year plan, and you have an exit strategy, gets you in, stops you from paying rent to the landlord, and you own that piece of real estate. This is something that not a lot of people actually talk about, but there actually are lenders, if you put 20% down, that will allow you to do room rentals to allow you to qualify for real estate. Again, conventional banks don't let you use room rentals to actually increase your qualification, but some of the alternative lenders out there actually do. Hey, this might be surprising, but what about moving in with your significant others? A lot of people that are looking to keep their financing separate these days, but a lot of times people are actually getting married and or getting together because of their financing, which might be crazy or not crazy for some, but maybe you guys don't live separately and you purchase a property and move in together. This has been said in a few different ways, but what about buying a property that has a rental component? If you have a separate suite or a carriage home on a property, again, depending on which lender you're using and how much you're putting down, that extra rental income on that property can allow you to increase your mortgage qualification, which might allow you to get into the market or get into something else. Somewhat controversial, cut your discretionary spending, maybe a few less Uber rides, maybe a few less door dashes to your door. Maybe you can actually drive down the street or make that coffee at home. Honestly, the reality is I see people's budgets all the time and they're spending $500, $600 a month on things like Uber Eats and delivery. And if you put that into, let's be honest, groceries aren't cheap right now, but if you put it into groceries, it might actually help you to get into the market sooner as opposed to spending that money on some dude driving that food to your door. What about a cashback mortgage? I've seen people say that they can't qualify for a mortgage because they have a certain amount of debt, but there are mortgages out there that actually give you cash cash back, 3%, 2%, 1% of the loan amount. You use that money, consolidate that credit card, that high interest 20% debt, and it actually could be the difference between qualifying for a mortgage or not qualifying for a mortgage at all. Early inheritance, baby. Listen, we don't want our family to pass away, but more often than ever, the wealth transfer is real. And the crazy thing is, I meet people all the time where I suggest the idea of a gift and they're like, oh, I never really thought about that. Ask your parents, what if you were to give me an early inheritance of whatever that is? Could we get access to that money today to buy a home? You'd be surprised how often the answer is yes. And people are able to get the money and get into a real estate market to purchase what they're looking for without having to wait for their parents to pass away. Have you talked to your employer? Now, this isn't an everyday thing and it's not every employer, but there are some different types of positions and some different types of industries that are super hard to keep and retain employees. And I've seen some of those companies actually go as far as offering employee assistance down payment programs, where if they do a certain number of service, certain number of years of service, they'll actually contribute a certain amount of money towards the down payment, which will of course get you into the marketplace. And although you might be tied to that employer, if you're happy and you love your job, why not? I think there's some great opportunities out there. And I think this is going to be something that more and more employers are actually going to look to do in the future. All right, we're not quite at 30, but I can tell you're probably exhausted, so I'm going to cut it here. Last big one, and this is massive. I see this all the time. Stop buying your car before your house. Car loan payments now are nuts. $1,000, $1,500, $1,200. Those car loans are the equivalent of $200,000 and $300,000 of mortgage money. And if you just get in the house first and then purchase your car or get your car loan afterwards, you can actually get a mortgage today and not wait until afterwards. Now, you don't need to do all of these different principles. You only need to do maybe one or two or three of them at most, and it could help you get into the marketplace. And I know a lot of people think the market's down right now. Well, that's a good thing. If you're a first-time buyer trying to get into the marketplace, you want to shop when it's a buyer's market and the market is deflated right now. Don't wait for the government to come to your rescue because they ain't doing it. If you like this episode, make sure to hit that like button, that subscribe button. I'll see you on the next one.